Happy Monday, everyone. Brent Tallman here with Fairway Independent Mortgage with a mortgage market update for February 20th, President's Day. So happy President's Day. Hope you guys had a great weekend and a fantastic week ahead. Two big things on this update that you're going to want to pay attention to. One is rates. Two is loan level price adjustments and changes to the automated underwriting system that are coming. That are going to impact you and your buyers, and you're going to want to pay attention to that. So let's get right to the rates. Unfortunately, I don't have great news on the rate front. According to Mortgage News Daily, the average conventional rate, and they have their stuff up to date, is 6.8. That's up 0.30 from last week. FHA 6.12. That's up by 0.24 from last week. VA 6.12. That's up by 0.20 from last week. I was at our realtor event happy hour on Thursday. By the way, thank you for all those who came. And a realtor said to me, hey, rates came down. That's because on Thursday, the press releases the Freddie Mac survey, and they showed rates had come down. Not fake news, just stale news. What happens is that's a survey conducted by banks and loan officers and lenders across the country. And they're due in by Wednesday, and they publish the results on Thursday. The problem is the majority of the people fill out all their surveys on Monday. That's when the majority of the people do. So come Thursday, it's old news. Market's always shifting, always changing. It's kind of like hurricanes coming. You know, they're predicting this and doing all that, and then all of a sudden the hurricane goes completely different. That's what rates do. Always moving, always changing. If you don't have a lender that's keeping you up to date with rates and what the market's doing, then please reach out to me. But the bottom line is, the CPI number on Tuesday came in way higher than expected. The wholesale inflation number came in way higher than expected. They were expecting 0.4, and instead it was 0.7. And so what that tells us is the Fed Reserve is going to have to keep their higher interest rate policy in place for higher and longer than anticipated. While the Fed does not directly impact mortgage rates, and if you want to know about that, give me a call, I'll explain it to you. Feds do not directly impact mortgage rates. They do, however, do it indirectly. And so the anticipation was come June or July, the Fed was going to have to start to curb their interest rate hikes. But based on based on what the economy's doing, that's no longer the case. They're anticipating this. The markets are believing it, that they're going to have to keep their hawkish attitude and outlook through the rest of this year, through 2023, into the beginning of 2024. And so the rates, I believe, are here for a while. The good news is they have priced in a lot of the changes already. We're at our highest level since November, and we really don't anticipate that changing too much, but we also don't anticipate anything helping to bring that down too much. So we're going to just have ebbs and flows between now and probably the end of the year. So what we have to do is shift our mind and shift our mentality and shift it to our buyers and be the leaders in this and explain to them this. Yeah, rates are a little bit higher. Historically, very, very low. Historically, they're great. Just compared to 2s and 3s, they're not. The other thing is we got to tell them about, hey, you're renting the rate. The minute rates can go down and you can refinance, you can do that. And so that's what we need to do. And the other thing we need to tell them is, hey, you're paying a mortgage. You're paying a mortgage. So it just may not be your mortgage. So why not pay your own mortgage? And the interest you pay on rent is 100%. And I have the ability to do a buy versus rent analysis for you and your buyers. So please reach out to me. Be happy to do that. All right, the second big news that I want to talk to you about is loan level price adjustments. I've mentioned it a few times before, and also a big change coming to the automated underwriting system. Okay, and here's what's happening. Loan level price adjustments. They are going to start hitting people if their debt to income ratio is over 40%. Then they're going to hit you even more if it's over 45. So what they're doing is they're adding fees or higher interest rates for those people who have a higher debt to income ratio. And that's going to impact your buyers greatly. The other thing that's happening, they're revamping their automated underwriting system and algorithm used to get approval. That's also changing. They're always constantly tweaking that. And so they have a big update coming here in March. And what it's going to do, they've already started implementing it actually. What it's going to do is those people with higher DTIs and lower loan to value and high loan to values are not going to get the approvals on a conventional side that they have been getting in the past. So you're going to see a lot of adjustments. And here's what I think the biggest adjustment is going to be. We're going to be seeing a lot more FHA loans in the market. A lot more FHA loans in the market. So make sure you understand FHA. A lot of myths, a lot of misconceptions about FHA. I'd be happy to talk to you about it, explain to you why FHA works, because that's what we're going to be dealing with, I truly believe. So with that being said, please feel free to reach out to me, 386-801-7362. Have a great day. Have a great week. And remember, now is always the best time to buy.